Joe Kelly. Good morning, everyone. I am Joe Kelly. I will be acting chair this morning. Ms. Greenwood was not able to join us. In her absence, Mr. Kehoe, if he's here, will be as alternate, will be a member of the committee. So good morning. I call the meeting to order. Linda, do you have some announcements for us?
Yes, thank you, Mr. Kelly. This meeting is being conducted as a virtual meeting, so I will do a roll call of the trustees to confirm attendance. Mr. Kelly?
Yes.
Ms. Jones? I see you.
There we go. Present.
Thank you. Mr. Jones?
Present.
Mr. Kehoe? Mr. Green? Mr. Knox? Ms. Sanchez?
Sanchez was just here.
Yeah.
Hello, I'm here.
Okay. And Mr. Santos?
Present.
Okay, staff participating in the meeting include the following: CIO John Grable and investment staff Vache Masarajian. We also have a guest speaker today, Bill Dudley, who's the former president of the Federal Reserve Bank of New York, and consultants include the Makita Investment Group and the Alborn team. Trustees, please use the Zoom chat option to be placed in the queue. At this time, we ask all meeting participants to mute their mics until you're ready to speak, and now we may proceed with the agenda.
Thank you very much, Linda. The second item on our agenda is approval of the minutes of the meeting of September 8, 2021. Have a motion to approve? Okay, I'll move the item. Is there a second?
Second.
Second. Any
Thank you.
discussion? Okay, if we can have a roll call vote in the minutes, Linda?
Thank you. Mr. Kelly?
Yes.
Ms. Jones?
Yes.
Thank you. And Mr. Jones?
Yes.
Okay, the motion passes unanimously.
Thank you. Next item on the agenda is public comment. Linda, do we have any members of the public who wish to speak this morning?
We do not.
Thank you very much. With that, we go on to item number 4. I'll turn it over to Vache to introduce our special guest speaker this morning. Good morning, Vache.
Good morning, Mr. Chairman, committee members, and trustees. I'm pleased to introduce our distinguished speaker, William C. Dudley, former president and CEO of the Federal Reserve Bank of New York and vice chair of the Federal Open Market Committee, which, as you know, is the part of the Fed that sets monetary policy. Bill was at the Fed during the 2008 financial crisis, so he has firsthand knowledge in how to manage monetary policy during and in the aftermath of a crisis. Bill's going to discuss 3 main topics. One is the Fed's current management of monetary policy and the anticipated impact on growth, employment, and inflation. We saw 1 week ago that the Fed raised rates 50 basis points after raising them 25 basis points in March. Yet the latest CPI numbers released this morning show that year-over-year inflation increased over 8% and core inflation was up over 6%. So Bill will offer his views on the appropriate path for the Fed funds rate to get inflation under control. As one Fed chair famously joked in the 1950s, the Fed's role is to take away the punch bowl just as the party gets going. I'm interested to hear if Bill thinks that's an apt description of the Fed's role, and if so, is the Fed too late in removing the punch bowl? Bill's second topic is capital market expectations. In other words, given the economic backdrop, what are the expected returns for stocks, bonds, and other investments? And his third topic is going to be digital currencies. Bill is a senior research scholar at the Griswold Center for Economic Policy Studies at Princeton University, and he's also chair of the board of directors of the Bretton Woods Committee, and he's done some work on the topic of digital currencies that he'll share with us. Now, before I turn it over to our guest, I'd like to thank one of LACERA's managers, Capula Investment Management, for putting us in touch with Bill and making today's presentation possible. So without further delay, I'll turn it over to our featured speaker, William C. Dudley. Bill? Oh, Bill, I think you're on mute.
We would learn how to unmute it in a timely way. But okay, so I'm going to start with the economic outlook, talk about the implications for financial markets, and then talk about digital finance and cryptocurrencies a bit. So where are we? Well, we're not in a good place. We're in an extraordinarily tight labor market. A way to get a sense of how tight the labor market is, right now there's 1.9 unfilled jobs for every unemployed worker. That compares to where we were in February 2020, right on the eve of the pandemic, when the unemployment rate was 3.5%, and we thought we were pretty much at full employment. The ratio was 1.2 unfilled jobs for every unemployed worker. So the labor market's never been this tight. The consequence of that is obviously upward pressure on wages, high inflation, and the Federal Reserve starting to tighten monetary policy quite quickly. On the inflation side, I think the numbers that we got today were actually quite disappointing. People were expecting better news on core inflation, inflation excluding food and energy. They didn't get it. Essentially what's happening is as the economy opens up again, the composition of demand is shifting away from goods to services. And we're seeing less upward pressure on goods prices as that demand shift occurs, but we're seeing more upward pressure on services prices. So if you look at, for example, owner's equivalent rent, if you look at airline fares, things like that that are more service oriented, those are showing considerable upward pressure. Services, excluding energy, in today's report, rose 0.7%. So that's an 8% annual rate for the services sector. So I would have to say that the news is not good, not good. Other consequence, of course, of this is the Fed finally belatedly has decided that the labor market's too tight, inflation's too high, their credibility is coming under question. And so they've begun to really start to tighten monetary policy, and they're starting to tighten monetary policy much more quickly. I think the mistake the Fed made was when they started. They probably should have started a year ago or more. But as you remember, they only began to raise short-term interest rates in March, and the first move was only 25 basis points, a quarter of a percentage point. Now they're moving a lot more quickly, 50 basis points. This past meeting, Chair Powell promised 50 basis points at each of the next two meetings. The Fed is basically going to 2.5%, 3% in terms of the federal funds rate, by later this year. That's I think almost predetermined at this point. So the question is, how do we end up in such a bad place? Well, I think there's a number of things involved. Number one, we had a lot of fiscal policy stimulus, which basically provided a lot of fuel for sustained consumer spending, even in the face of high inflation. So you ask yourself the question of how can people continue to sustain their spending when wages are running 5.5% and inflation is running 8%? The reason is that they have a lot of savings. And a lot of that savings was accumulated through the fiscal packages that were passed first in the Trump administration and then by the Biden administration early in 2021. People estimate that the household sector has about 2 to 3 trillion of excess savings still available to spend. The second reason why we got here is monetary policy. The Fed did not take away the punch bowl just as the party was getting good. The Fed modified their monetary policy operating model a couple of years ago, and basically they said we're not going to tighten monetary policy at all until inflation is 2%. We're confident that inflation is going to be above 2% in the future, and we're at full employment. So what that meant was the Fed was basically saying we're going to sit on our hands until we achieve all three of those objectives. Well, by definition, that meant the Fed was going to be late, right? Because at a time that monetary policy needed to be neutral or tight, the Fed would still be at a 0% federal funds rate. And that's really the situation we saw ourselves in March. So the Federal Reserve is very far behind the curve in terms of tightening monetary policy. They still have a considerable ways to go to get to neutral, and now they're catching up. The good news is I think they understand that they're behind, and so they're moving much more quickly. The bad news, of course, is financial markets are coping with a much more austere monetary policy going forward. And the last reason why we got here is we were unlucky. The supply shocks, are the hit that just keeps on giving. First we had supply shocks caused by the COVID pandemic. Now we're having supply shocks caused by the Ukraine-Russian war. We're having supply shocks generated by China's shutdown in terms of how they're coping with their own COVID caseload. And so the supply shocks are just turning out to be much more long-lasting than anybody anticipated. So put it all together, I would say it's a combination of bad policy and bad luck. So what are the implications of this? Well, first, the Fed needs to move to a tight monetary policy. Fed hasn't really quite admitted that yet. Powell in his press conference last week basically says we have to go to neutral expeditiously. He was asked by, well, what happens after that? And he basically said, well, we'll see when we get to neutral, what's next. But I think that the reality is the Fed's going to actually have to get to a tight monetary policy, because the sad fact is that the labor market's too tight. And the way you loosen up the labor market is you tighten monetary policy, slow the growth rate of the economy. That pushes up the unemployment rate. That generates more slack in the labor market, and that's what actually pushes inflation back down again. It's not a pleasant process, both for people in the labor market or for financial markets, but that's what the Federal Reserve has to do. The second implication of this is monetary policy gets tightened, financial conditions also have to tighten. Chair Powell has been very clear that he thinks that monetary policy works through financial conditions. So it's not just about what the Fed does in terms of raising short-term rates. It's how the increases in short-term rates affect the bond market, the stock market, the value of the. I agree with Chair Powell. That's how monetary policy works in the US. It works through the bond market and the stock market. And so financial conditions need to tighten. And that's what the Federal Reserve is starting to accomplish. So when the Fed looks at what's happened to the stock market over the last few months, they're not unhappy. When the Fed looks what's happened to the bond market over the last few months, they're not unhappy. This is what they need to see happen to restrain the pace of economic growth. So it's not fun for investors, but this is not, but this is by design. This is not a flaw in the monetary policy regime. This is by design. Third implication is that the risk of a hard landing of a recession has increased, not this year, because the economy has quite a bit of forward momentum. Right now, supply is inadequate to keep up with demand. We're still in the process of reopening the economy. We're still in the process of businesses adding more workers because of the shortages that they have. So recession is not going to happen in 2022, but beyond that, the track record for the Fed looks really quite grim. There's never been a case since World War II where the Fed has had to tighten monetary policy sufficiently to push up the unemployment rate by a meaningful amount, and the economy hasn't ended in recession. Chair Powell cited 3 examples where the Fed has tightened monetary policy and the US economy didn't go into recession a couple months ago, 65, 66, 84, 85, and 94, 95. Well, unfortunately, those examples don't really apply to the current set of circumstances, because in all 3 of those cases, the unemployment rate kept declining. The Fed can't allow the unemployment rate to keep declining. If that happens, inflation will just keep climbing. So this is one of those situations where the Fed has to push the unemployment rate up, and they've never been able to do this successfully and avoid a hard landing. Now, the timing of when this hard landing occurs, I think, is very much up to the Fed. If they're aggressive in tightening monetary policy in 2023, well, then maybe we'll have a hard landing next year. If, on the other hand, they take some comfort by the fact that the inflation's peaked this year and it's coming down a bit, and to decide not to move so aggressively to a tight monetary policy, then maybe they can push the recession risk off a bit. But if they don't push up the unemployment rate, inflation will start to reaccelerate. And so delaying the tightening doesn't mean there won't be a recession. It just means that the Fed will have pushed it off in time, and probably what will mean that is the recession will probably be bigger at that time. Last implication of all this is the very strong returns we've gotten used to in financial markets over the last few years, due to very low interest rates, very accommodative monetary policy, very stimulative fiscal policy. Those strong financial asset returns are going to be a lot harder to come by going forward. The US bond market was basically in a bull market from 1982 all the way till 2020, 2021. That's a long bull market, lasting almost 40 years. That bull market in bonds is over. And with that end of the bull market in the bond market, that means tougher comparisons, competition for the stock market. So I think both the returns that we're going to get from the bond market and the stock market are going to be lower going forward. Unfortunately, also you're going to be a bit inhibited by the fact that the US economy just can't grow very fast from here. Given that we're at full employment, top speed for the US economy over the next couple of years is probably only 1.5 to 2%. The prime age population in the United States is only growing about 0.5% a year. So if you can only grow 1.5%, 2% a year, that puts a lid on how fast corporate earnings can grow. So that also will put some limits on the upside of the labor market. So what to watch for going forward? Well, the first thing I would say is really keep your eyes really closely pinned on the labor market. What's happening to the unemployment rate? Is it falling further? And what's happening to wages? Right now, wages are running 5.5% on a year-over-year basis. That's not consistent with the Fed's 2% inflation trajectory. It's more consistent with inflation of around 4%. So if the Fed doesn't tighten monetary policy enough to push up the unemployment rate and bring wage inflation down, we have an ongoing inflation problem. The second thing to watch is obviously the inflation numbers and especially inflation expectations. In other words, how worried are people about the Fed's willingness to do the job to push inflation back down to 2%? So far, inflation expectations have remained very well anchored. So people are still pretty confident the Federal Reserve at the end of the day is going to do its job. Quite surprisingly so, frankly, given how high inflation is today. If inflation expectations start to become more unanchored because inflation just stays high and the Fed's not as aggressive as they maybe need to be, that will also make the Fed's job a lot harder. So watching that. And then finally, we have a couple of wild cards in the global economic outlook. The first is the war between Russia and Ukraine. That's generating another supply shock in terms of grain and energy prices. The good news for the US here is we're better situated than other countries because we produce a lot of energy, we produce a lot of grain. So the negative effects to us on inflation will be offset by some positive effects in terms of the fact that this actually benefits us in the sense that we produce these two commodities. The second wild card is China and the shutdowns that they're going through to cope with the COVID pandemic. This one I'm a little bit less concerned about because this is a choice that China's making. And if the cost of the COVID shutdowns just turn out to be too disruptive to the Chinese economy, then China can pick a different strategy. They don't necessarily have to stay on this strategy. But for now, it is sustaining the supply disruptions that we've seen. And that's a factor that's keeping inflation in the US higher. So with that, let me switch gears and talk a little bit about digital finance and cryptocurrencies.
Mr. Dudley, are you open to taking questions on your?
Yeah, we can take questions on the economic outlook and markets now, and then we'll turn to digital finance and cryptocurrencies.
Okay, thank you so much, sir. Ms. Sanchez.
Thank you, Mr. Dudley, for your comments. I have a question, and I know that this is where you come from, so please don't take offense to the framing of the question, but I think you might be giving the Fed a little too much credit in terms of coming in when they came in. To some degree, I feel like what actually urged the Fed to go forward was the incursion into Ukraine, and the spike in oil prices really sort of brought to the fore this notion that something had to be done as inflation really started to take hold. And by the same kind of notion, it is my opinion that in fact commodities prices and the hangovers from the supply chain disruptions that occurred through the pandemic and led us into sort of a very, very weak supply condition going into the Russian invasion, that those actually may more swiftly calm the economy and take out demand faster than financial conditions will. But that's my view. And I actually wonder if as soon as inflation starts to peak and starts to show signs of moderating, that the Fed may not finish the job. Thoughts?
Well, two thoughts. Number one, I've actually been pretty darn critical of the Fed in terms of being late. So I don't think we really disagree on that point. I think the Federal Reserve should have responded much more quickly. So I think we're in huge agreement on that point that the Federal Reserve has been late. I think this issue about whether the Fed will take comfort by inflation being lower a year from now is really germane to the economic outlook. I do worry about it, that they'll take too much comfort by a decline in inflation caused mainly by unwinding of transitory factors like used car prices that went up very sharply last year. They're probably going to come down this year. And also, some of these supply chain disruptions I do think will be solved at some point, for example, in the auto sector, for example. So I think that you're raising a very, very important point. Will the Fed take too much comfort from a decline in inflation from its peak and not enough discomfort from the fact that it's still high relative to the Fed's 2% objective. My view is that they should get the job done, and delay is actually bad because we've seen that story before. It's a long time ago, back to the 1960s and early 70s, where the Federal Reserve delayed in tackling inflation, and what happened was inflation just kept ratcheting ever higher. And so at the end of the day, what had to happen, Paul Volcker came in 1979 and essentially had to put the economy through a ringer, not just one recession, but two recessions back to back to break the back of inflation expectations. So I'm hoping that we don't get to that point. Now, Chair Powell has talked about Paul Volcker a lot, and he has sworn his commitment to 2% inflation. But as you rightly point out, talk is cheap. It also has to be followed up with action. So we'll have to see. We'll have to see. It's going to be a very challenging time for the Fed.
Thank you.
Thank you, sir. And I don't have any other, Mr. Grable, one more question.
Sure, thank you. Questions to follow up on this topic, and it relates to, Bill, you've been in the room, a really important room, and something that we discussed, that we're in a different environment, and some of our business partners have no experience managing money in an environment where cost of capital is increasing and equity multiples are contracting. That's very different than the inflation we've had in financial assets, which has benefited investors. So the question for you is, the same applies potentially to the Fed in terms of the people in the room are learning. It's somewhat academic in terms of those parallels. And you cite an example, 1965 may not have been applicable, but no one at the Fed was working at the Fed in 1965.
I hope not.
So in terms of the people in the room and what the Fed does, given that this is a live exercise with that the people don't have direct experience, how does the Fed navigate this?
Well, I think you underscored the fact that it makes it harder, because you build a whole model based to sort of fight the last war. So you think about, why has the Fed been so late this cycle? They've been late this cycle because last cycle they were having trouble pushing inflation back up to 2%, and they were having trouble getting the economy to full employment. The last economic expansion was a very slow expansion. It took us a long time to get back to full employment. And so they designed a monetary policy framework that was well suited to making monetary policy more expansive so that it would provide more support to the economy. Now, it turned out that's not where we are. We're very late cycle right now. We're not early in the economic cycle. So you're absolutely right. It's really important to make sure you are fighting the right war. And I think they basically just misdiagnosed what they were going to face coming out of the COVID pandemic. Now, in their defense, it's not like we've had a lot of experience, recovering from pandemics. And I think that, the government broadly, both fiscal and monetary policy during the early stages of the pandemic, I think did the right thing by providing lots of stimulus to try to reduce the destruction to the economy. But I think what happened was people were very slow to shift gears. I mean, I think the Biden administration deserves some responsibility as well. I mean, the $1.9 trillion package was probably bigger than it needed to be. And I think probably more the area where I'd be most critical about the fiscal stimulus from the Biden administration was that they handed out checks to people, even if the people were still fully employed. So a lot of people got checks who didn't really need the checks. And so that's what's putting the household sector with the ability to continue to spend money, even at a time where inflation is rising quite a bit faster than wages. So it's been a bit of a party, I guess I would describe. And as we talked about at the beginning, the punch bowl is being taken away. And I think, what's the problem right now is that people don't understand what that fully entails. I think there's still this notion that if the stock market goes down another 15, 20%, the Fed will stop. I think there's a notion that the peak in short rates will be 3 to 3.5%. I think the peak could very well be considerably higher than that. I think that people probably have a unrealistic expectation of, financial asset returns over the next 10 years, because they've been so high over the last 10 years. And so I think all these things are going to be hard for people in markets to adjust to. So I think you're raising a very good point.
Thank you, sir. We have two more questions. Ms. Jones?
Yes, good morning. My question is around what you just discussed, the pandemic and that it's come to an end. And I guess my question is, have we really come to an end? Or is this just a pause? Have we looked at what would happen if the number of cases start going back up, hospitals start overflowing? I'm just curious where we're at with that. I know in my environment, we've had cases go really low, but I'm starting to see them trickle back up. More
Yep.
recently, I work for, a city. So, we have employees that are all over and we're just starting to slowly see an uptick. And I'm just curious, are we really safe to say this is the end of the pandemic?
No, I don't think we're at the end of the pandemic. In fact, there were some reports, I think last week, that were talking about the fall, this coming fall, winter, we could see another surge in the pandemic. I think a couple of things have happened that are fundamentally different. Number one, Omicron variants are just less lethal to people than the preceding variants, especially if people have been vaccinated and boosted. And so the risk of getting COVID now is significantly lower than it was before because of the vaccines and because this variant is just less virulent. The second thing is people are just tired of this. And so for any given degree of risk, there's just less social distancing now than there was before. And that's just a fatigue factor. So people have basically changed their sort of risk reward preferences. They're willing to take more risk to take a plane flight, to go to the movie theater, to go out to eat than they were before. And I think my own view is that unless there's a new variant that's a lot more virulent, that comes back and spreads very quickly through the economy, I think we're really, I think people's behavior is pretty much done with COVID. So I think COVID is going to be with us. It's going to be endemic. But unless there's some increase in the virulence that scares people again, I think that, people are going to tend to go about their business again. And you see that, I see that just in my own, activity. I mean, people aren't masking anymore, most of the places where I am, which is a very, very big change is just from a couple of months ago. Even though you could argue that masking is still a completely reasonable thing to do from a health perspective.
Thank you, sir. Batche, last question for this section.
Thank you. Bill, I'd like to go back to something you touched on in your comments, which is the change that the Fed made almost 2 years ago in their framework, targeting average inflation as opposed to keeping it at 2. Do you think that's part of the reason why the Fed was kind of slow to start raising rates? And if we were under the old regime, so to speak, would they have started earlier?
I think it was a factor, but I don't think it was a big factor. I think the switch to 2% inflation on average was a response to the fact that they were having trouble hitting their inflation objective of 2%. Inflation was below 2%, and so inflation expectations were starting to sink as the Fed consistently failed to meet their 2% objective. And so they switched to a 2% average inflation regime because they basically said, look, we want to make sure that inflation expectations stay well anchored at 2% because that'll make it more easier to hit 2% inflation in the future. And I think that was all made sense. But the problem was how they operationalized it. They basically said, we're going to do this by tying our hands and basically not raising rates at all until we've actually achieved these three objectives of inflation at 2% and expect to be above 2% in the future and at full employment. They didn't have to do it that way. They didn't have to operationalize it that way. They could have started to raise interest rates much sooner and still had a 2% average inflation targeting regime. I mean, think about the old regime. What the Fed was trying to do was get to a neutral monetary policy at the same time the economy got to full employment and the economy got to 2% inflation. So in an ideal world, you were at neutral monetary policy, full employment, 2% inflation. And the Fed was basically pretty much there in February 2020 before COVID. I mean, inflation was maybe a little touch below their 2% objective, but the difference was really tiny. I mean, that the Fed would have liked to stay there. But now they're in a different regime where they're patient. And then by the time you realize that you got to move, you're far away from where you need to be. And the Fed doesn't want to just raise rates 300 basis points instantaneously because, boy, talk about, risk to financial markets. If the Fed all of a sudden had a meeting and said, well, we decided to go to neutral today. and we decided that neutral is 3% on the federal funds rate, that'd be quite a shock to financial markets. So that's not really an option either. So I think they're going to have to revisit this. Powell claims that there's nothing wrong with their framework. I think there is something wrong with their framework. They need a framework that's more flexible for risks on both sides, risk of inflation being too low and the risk of inflation being too high. So they need a more flexible framework. I think some preemption in policy is always a good thing on both sides. You know, when you see weakness, you respond by easing even before you're in recession. When you see strength and inflation, respond by tightening even before you necessarily reach full employment. So I think a somewhat preemptive monetary policy makes some sense.
Thank you, sir. And Mr. Jones snuck in on us. Mr. Jones, good morning.
Yeah, good morning to you. Thank you, William. I really appreciated the analysis. So question for you. So in retrospect, I think part of the flooding, if you will, the market with liquidity, particularly after March 2020, was for fear of collapse of aggregate demand and then all the employment components that were through there. And so what's interesting to me as somewhat of a policy nerd is now on the other side of it, we want to treat the kind of triage experience, particularly with households of cash, right, trying to maintain a certain level of aggregate demand, as if it was a policy error kind of in retrospect. And so I'm curious, and one other factor I want to get your feedback on. So if I'm sympathetic to Powell a little bit in some of the constituencies that were around him saying, listen, in previous recessions, the Fed's response has been so fast that it actually prolonged the level of labor market recovery and balance sheet recovery for a very vulnerable part of our kind of economic spectrum. And so if you're trying to be inclusive of saying, I want to make sure the conditions include those most likely not to have the economic wherewithal to recover as quickly as some others, I'm just curious to kind of, as a, you know, having been an insider there and kind of empathizing with where Powell is now, you know, how would you have accommodated the same data points and the same concerns at that level? Just curious.
Well, I think the goal of, you know, trying to support low and moderate income houses that are less advantaged in terms of their ability to find jobs and build their human capital is a very good one. So I think that's a very laudable goal. But I think the way you do that is you manage the economy so it stays on an even keel and inflation doesn't get out of hand. Because if inflation gets out of hand, then you have to respond to the inflation. And guess what's going to happen to all those people that were hired, you know, sort of at the end? You're going to have an economic downturn and they're going to be out of work again. So I think, you know, Powell, I think, has pivoted. You know, he talks now about how we need 2% inflation so we can have a strong labor market. We can sustain a strong labor market. I think that's the right message. But I do agree with, you know, the tenor of your question. You know, it's a very laudable goal to try to get people employed. And when I was there, I was very much of the view is we don't want to prematurely cut off the economic expansion by guessing where full employment is. We want to basically make sure we get to full employment, get as many people employed as possible, and then once we're there, we can sort of see how we need to respond. So my critique of the Fed is not trying to be more inclusive. I think that's a very good goal. My critique of the Fed is not trying to get to full employment. I think that's a very good goal. I think the problem is just that the gap between where they are today and where they need to be is very large.
Thanks, William.
Thank you, sir. That concludes our questions for your first part of your talk. You can go forward now.
Okay, so I'm going to talk a little bit about digital finance and cryptocurrencies, and I'm going to give you a fairly, I think, nuanced view where I'm not a true believer, but I'm not also, you know, a sort of enemy of digital finance. So first of all, starting with cryptocurrencies, I'm not a big fan of Bitcoin. I think Bitcoin is basically a speculative asset. If you look at Bitcoin, you know, it's supposedly designed to facilitate payments, but it's actually not a very good payments medium because one, it's not a stable store of value. I'd much rather hold $1 than a Bitcoin. And number two, it's not very effective as a payments medium because it's very expensive to transact through Bitcoin, and the amount of transactions that the Bitcoin network can handle is really, really small. So you could not run a global economy on the Bitcoin blockchain. It just wouldn't work because the throughput is very, very limited. So I'm not a fan of Bitcoin. What I am a fan of is some of the innovations that are coming out of digital finance in terms of blockchain technology, because I do think the technology actually holds a lot of scope for innovation that could make the financial system much more efficient and inclusive in the future. There's a number of areas where we're really struggling in terms of the efficiency of the U.S. financial system. One is anti-money laundering, Bank Secrecy Act compliance by banks. They literally spend billions of dollars a year to comply with this in a very costly way. Another area where we have a very inefficient system is where people who are migrant workers try to send money to their families at home. The average cost of actually executing these payments is averaging about 6% of the value of these payments. That's a really high frictions in cross-border payments. That's another area where I think innovation in digital finance might help. Mortgage finance is another area. I think it's still amazing to me that we still do title searches. You have to get a title company to validate, whether there's another lien on your house. This can be done much more efficiently through the blockchain, making it very clear that the title had passed to this new person. There's a permanent record on the blockchain, and we don't really actually have to do a title search again in the future. So I think that the technology actually has a lot of potential. How far it goes, though, depends a little bit also in terms of, the regulatory response. And I think up to now, we really have two problems on regulation. The first problem is we don't have much regulation in all of this space. And so we're actually seeing a number of accidents. There's been a lot of cyber theft in the cryptocurrency space where people are basically going in and, essentially robbing people's wallets of cryptocurrency. And that's, so it's a bit of the Wild West, in terms of there's no law enforcement on the scene to prevent these kind of thefts. And a second area where we have lots of problems is that there's no real adequate protections for consumers and investors, in terms of guardrails. So stable coins, some stable coins aren't backed by much of anything, but other stable coins, some stable coins are backed by reserves, but those reserves are not, U.S. government securities always. And so there's a lack of regulation to really, make this a safe place for people to do business in. And a lot of households are dabbling in cryptocurrencies now. I think there was a study I saw, that Pew study, that said something like 19% of people in the United States, households in the United States, had dabbled in cryptocurrencies. So I think we need to get some guardrails in place to make sure that the people who dabble, can do so safely. The second criticism I have on the regulatory side is they're not really, engaging it with this new industry in sort of a constructive way. Like, we need to make this industry safe, but the regulators need to, also lean forward and sort of embrace these new technologies and figure out how these new technologies can actually make the financial system work better, rather than sort of just reject them out of hand and support, the incumbents in the current regime. And so my view is that, we want the regulators to have regulation, but we want to have the regulation that actually sort of fosters and encourages the development of this industry, rather than stifles and crushes the industry's development. I think the Biden administration understands that they're behind the curve. The president has basically said, we got to get going on this. Janet Yellen, the U.S. Treasury Secretary, has said that we've got to get going on this. And so I think that's good. People understand that we do need regulatory guardrails. I think now the question is, what do those guardrails look like? And do they foster the integration of these new technologies into our financial system, or do they stifle the development? That's what we're going to see over the next few years. But it's a very interesting space with a lot of excesses in some respects, which I think you need to be very cautious about, but also a lot of promise in terms of the actual underlying technology.
Yes, sir. I don't have any questions in the queue. No questions? Okay. Oh, wait, Jonathan Grable. Yes, sir.
Just on the crypto front, and I'm hardly an expert, the whole ecosystem, including the regulatory environment, what's the role of, I know LACERA, we're dependent upon State Street, our custody bank, in terms of holding our more traditional assets. What type of discussions have regulators had with these critical third parties in order to build out a more fulsome ecosystem?
Well, I think we're in a sort of interesting place where customers are interested in cryptocurrencies, but large businesses are quite reluctant to get involved because they see the lack of guardrails and they worry about their legal risk. And so they feel like if I just plunge into this space and satisfy the demands of my customers who want a place safe to place, a safe wallet for their crypto assets, who want to have, there's sort of a disconnect there between, what the customers want and what the established incumbents are willing to provide because of, I think, of the legal risk. So I'm on the board of a major international bank, and we're very reluctant to go very far into this space just because we don't feel like the guardrails are in place. If we were to get engaged and something bad were to happen, what kind of legal liability would we be taking on? And so I think that's really slowing down the incumbents. So that's another reason for getting these guardrails put in place. If we understand what the rules of the road are, then that will reduce people's legal risk, because they'll say, well, as long as I comply with this, I'm doing what the SEC and the Federal Reserve wants. So then I can point to someone and say that I behaved in a prudent way, in a responsible way. So I think that's a bit of another aspect of the current challenge. While the incumbents are, they're studying this very carefully. I mean, I think the incumbents, large financial firms, are spending a lot of time understanding what's happening in the space, understanding the potential positive benefits of the technology. But I think they're really reluctant to actually provide products yet because of this potential legal liability.
Thank you. Okay, I don't see one more question from Bache.
Bill, maybe we can tie the two different topics, monetary policy and the cryptocurrencies. If the central bank were to introduce a digital currency, how might it impact the conduct of monetary policy? Would it allow the Fed to interact more directly with the end consumer rather than going through financial conditions? Would that mechanism be more direct?
Well, I mean, in principle, the central bank in principle could issue digital currencies to every household in the United States, and in principle, they could even pay interest on that digital currency. But the Federal Reserve is not going to do that. The Federal Reserve is basically, if the Federal Reserve develops a central bank digital currency, it'll be wholesale, and that digital currency will be then distributed through financial intermediaries who will actually own the relationship with the end customer. The Fed doesn't really want to get into the business of providing financial services for U.S. households and businesses broadly. They're going to be a wholesaler, not a retailer. So I don't think we're going to. I'd be extremely surprised if the Federal Reserve went down that path. There's a huge problem if the Federal Reserve decided to take a much bigger role, because during periods of financial stress, if the Federal Reserve was providing all these accounts to customers, you can imagine all the money just running to the central bank, because people would be, boy, the central bank is safe. And that could be very destabilizing for the rest of the financial system. So that's one reason why I don't think it's a very attractive model from the Fed's perspective. Not to mention they don't have the technological infrastructure to interact with 100 million households.
Okay, thank you.
Thank you, sir. I don't see any other questions for this section. And move on then, sir. No other questions. You're okay to move on, sir?
Sure, absolutely.
All right. Well, I think that concludes this session then, unless, Bill, you have any other final comments. But let me just say again, thank you very much for those insightful comments. We very much appreciate you taking the time to speak with us.
Well, it's my pleasure.
Thank you again, sir. A very interesting conversation.
Thank you.
Thank you. Bye-bye.
Bye-bye.
And Bache, thank you and your team for inviting him to our meeting. It was a really, really interesting discussion. It was very nice. So thank you for that.
Sure, sure.
Okay, that was our main item for today's meeting. Linda, do we have any items for staff review?
We don't.
Okay, no items for staff review. Good of the order. Mr. Jones? Anything? No, Ms. Jones?
No, I have nothing. Thank you.
Okay, Ms. Sanchez? Ms. Sanchez, Mr. Santos?
No, nothing from me.
Okay. No, you're Mr. Kryman, Mr. Santos.
Oh, that's right. That's right.
I finally got it right in my own head. Mr. Santos, anything? Okay, nothing. Okay, I had my stitches out. So for those of you who don't know, I had an accident a few weeks back where I was washing a glass. I decided to do the dishes. I washed a glass and broke my hand. And I had a hanging thumb, I called it, because the whole back of my thumb sliced off. So I rushed myself to the hospital and I got 13 stitches. But they're out and I'm really happy and it looks perfect and I'm really excited about it. I don't have a white thing on my thumb anymore on my left hand. So I just share that. Okay, thank you. Oh, okay, let's go to the order. Okay, do I have a motion to adjourn?
So moved.
Seconded. And with that, thank you very much for a great meeting. And we'll see you at 9 o'clock, the same meeting numbers. Thank you, folks.
Thank you.
Yeah.